Toyo broadly missed Wall Street's Q2 consensus. I mean, revenue came in at just $118.18 million, which is missing estimates by roughly 40%. Those estimates were originally hovering around 192 to 204 million. Q2 diluted EPS landed at 45 cents, again, missing targets of 52 to 69 cents. And, well, management just fully withdrew their 2026 full-year guidance.
Yeah, and the market absolutely hated it.
Right. The stock plummeted 24.2% on earnings day to $4.34, and it was trading on like 5 times its average volume. So what is actually happening under the hood here to cause that?
Well, to figure that out, you really have to look past that massive top-line miss and, see the deliberate product mix shift that's happening. The sequential top-line contraction was caused by this shift. Basically, in Q1, Toyo delivered about 1.45 gigawatts of midstream solar cells, but in Q2, that dropped to 1.16 gigawatts.
Oh, wow, okay.
Right, but at the exact same time, their downstream module assembly, so the finished solar panels, actually accelerated. That jumped from 55.7 megawatts to nearly 135.8 megawatts.
Wait, I'm struggling to square that, though. If they are, just selling a different, more finished product, how does 40% of their expected revenue just suddenly evaporate?
It is all about contract life cycles. When you sell those midstream solar cells, it's essentially a quick transaction. You ship the cells, you book the revenue, boom, done.
Okay, that makes sense.
But downstream module assembly involves, well, much longer-term contracts and installations. You literally cannot recognize that revenue on the books until much later in the project lifecycle. So this transition, it introduces this massive delay in cash flow, creating revenue that looks highly, lumpy on a quarterly basis.
So this is basically just structural growing pains. Like, is it kind of like a software company losing that initial top-line revenue when they transition from one-time software sales to a SaaS subscription model? Like, it looks terrible on the balance sheet today, but theoretically, it's highly profitable later on?
Yeah, that is actually a really solid comparison, but obviously with the physical supply chain twist, right? A software company doesn't have physical inventory just sitting on a dock somewhere.
Right, exactly.
But you are right about the profitability part. The margins actually prove this was a deliberate upgrade. First half gross margins nearly doubled year over year to 32.5%, and that was driven by a 153.9% surge in premium U.S. sales.
Wait, so if margins are up that much, why did management completely withdraw the 2026 guidance?
Because of the unquantifiable regulatory risks. Right now, U.S. Customs, or the CBP, is detaining Toyo's Ethiopian cell shipments. They are doing reviews under the UFLPA, which is the Uyghur Forced Labor Prevention Act. And just as a quick reminder for you, we are simply reporting on what the source material states regarding these regulatory actions. We aren't taking any political sides here.
Right, of course. So that means Toyo has to rigidly prove the origin of every ounce of their silicon to ensure no forced labor was used anywhere in the chain.
Exactly. And you add to that the Section 232 tariff negotiations with the Department of Commerce, which remain entirely unquantifiable right now. You just can't accurately forecast revenue when your core products are stuck in customs limbo,
Which perfectly explains why Toyo is rushing to build out a massive U.S. footprint to bypass this. They have that $357 million Texas HJT cell facility, that's heterojunction technology, which remains on track for late 2027.
Right, but building that domestic footprint is not cheap at all. Q2 operating expenses literally doubled to $25.9 million just to support this U.S. expansion.
Wow, so that creates some intense near-term margin pressure.
It does, and the market is weighing this execution risk against a really deep value multiple. I mean, value buyers actually stepped in the day after the massive sell-off, and they bounced the stock back up 4.1%.
So they are clearly looking past the lumpy revenue and betting heavily on this long-term onshoring strategy. Speaking of which, to stay compliant while they build that Texas plant, Toyo is rapidly shifting to source 70% of its polysilicon directly from the U.S. for its Ethiopian operations.
Yeah, it is a huge pivot for them.
It really is. And it leaves you with something to really mull over as you watch this sector. What if the true future bottleneck in global renewable energy isn't our capacity to manufacture solar panels, but the geopolitical origin of the raw silicon itself?
That is a great point. It completely shifts where the real leverage in the supply chain lies going forward.
Definitely. Well, if you want to keep tracking these volatile market transitions, make sure to follow the show for our daily earnings coverage.